Okay, folks, good morning and welcome to Swing Trading Today. Let's first make an announcement. I'm going to be doing a webinar with TrendSpider on Sunday evening. So if you're watching this on YouTube, there's a link below. If you'd like to join in, please take a moment, sign up. And if you watch this on the website, the link will be above as well. So please, Sunday evening, if you have any questions, you'll be able to ask them. So let's get to the morning activity. Concerns that I had began yesterday afternoon as we saw gold begin to pull back a bit. Let's go to a daily chart. So gold was unable, despite the fact we had a dovish Fed chair, to put in a new daily high, and it closed off of the highs of the day. So I'm a bit concerned here about gold in the very short term. Longer term, I am not. What do I think the proximate cause of the weakness in gold yesterday was? I think it was because the markets did not get what they wanted. They wanted a more dovish Fed. They didn't get it. Let's bring up the TNX. This is the yield, the 10-year yield. And you can see that yields have broken out. So think about it. We had a Federal Reserve chairman who was by and large dovish, yet yields broke out. Why would that be? The reason is it's not enough. The Federal Reserve can only control the short end of the yield curve. They need to go out to the longer term bonds and they need to begin buying them. In short, the markets appear to be expecting more quantitative easing. So here you have a daily breakout on yields. And if you take a look down below here on a weekly breakout, we did so back here last week when we broke out. We were a bit oversold. This week, a continuation move higher. And when you bring up the historical trend lines, you could see that we were bouncing off of historical support for several weeks. We briefly dipped down to a one handle, but we bounced back. So we may have gold traders out there looking at the rising yields and saying, oh boy, maybe everything isn't as dovish as we might hope. But I wouldn't worry about that because historically, once inflation gets out of control, yields and gold can rally in tandem. Let's bring up the tips. Tips are the treasury inflation protected securities. You can see that we have a head and shoulder setup forming. Left shoulder, head, right shoulder. Is this the neckline? If it breaks, in all probability, yep. So keep an eye on the tips, very short term. We may get some weakness here if we get a continuation move higher on the 10-year yield. Let's take a look at the stock market. Okay, it looks as though we are set to have a pretty good day here, at least the morning anyway. We are breaking out this morning above resistance, and it looks as though we're gaining a little bit of steam here, which is a good thing. In fact, let's do this. Okay, so bull flag breakout potential here on the S&P 500. The path of least resistance remains up. Folks, let's leave off with Bitcoin. All right, so on a weekly chart, what we're seeing here is a bit of topping action as noted by these topping tails here. The trend is still in place. So if you're long, stay long. But just understand you're seeing some profit taking up at the 13.5 level, and you should be wary. Now, on a daily basis, you can see that we have more topping tails above. The past couple of days we've been consolidating sideways, and here's our new lower band of support. So for me to want to get long of Bitcoin yet again, I like a breakout. I like a breakout above this upper band of resistance, and I would look to get long at that point in time. But right now we're just consolidating. Let it consolidate. Let's ensure that it holds this lower band of support, and we could always look to get long yet again. Remember, we're having a webinar with TrendSpider on Sunday evening. Click that link if you watch us on YouTube down in the description area below to watch us. And if you watch us on the website, please click the link above and make sure you join in as well. Again, Sunday night TrendSpider Q&A session, demo. We'll have a great time. See you there.